Hi, I'm Keith McCullough. Welcome back. I want to talk about why the stock market's going down today. It was on a critical economic data point called the ISM report. Now, the ISM report revealed two very important things that matter to us that we've been talking about on an ongoing basis for the year to date. Number one, inflation's accelerating. So in the prices paid component of the ISM number, you saw it go from 53 in December to 60 in January. So prices are going up. At the same time, the growth side of the ISM survey completely missed. This was the worst new orders growth component, new orders number since 1980 from a peak to trough perspective. It went from 64 to 51 new orders. That is horrendous. So the stock market's going down today, and for good reason. So let's get into the why. Let's review some of the big components of inflation and growth that we care about most here at Hedgeye. The first point I want to make is A, inflation is no longer deflating, it's reflating. So again, that's a problem. Costs go up, both for you, the consumer, and you, the producer. If you're a producer and a consumer, well, both your costs are going up. So what are you going to do with that? You get squeezed. Second point, point B, at the same time, growth, in particular in the U.S., which I just pointed out on the ISM number, and it's not just the ISM number. We've had a lot of growth numbers slow on the margin. And again, a lot of people would say, well, you know, it's not that bad. Well, that's not the point. In macro, it's what happens on the margin that matters most, and that is precisely what's happening to growth. It was too hot, and now it's starting to slow, so you're seeing that slow as opposed to what we liked last year about the U.S. growth trajectory, whereas it was accelerating. Now, let's get into the inflation underneath the hood, because people aren't used to this because, of course, we had deflation in commodity prices last year. But you could see this on a one-week basis last week. I mean, we had some pretty surreal moves in commodity inflation. There's a couple ETFs we've been focused on, coffee ETFs in particular. CAFE, C-A-F-E, is one that we've liked. Now look what coffee did last week. I mean, that's not deflation. That's some little inflation in your coffee cup. Yeah. What about cocoa? You put some of that in your coffee? Well, that's getting more expensive too. Now let's look at this from a year-to-date perspective. Same thing. This isn't new. This is a trend that's developing. That's why we call it, again, a Hedgeye macro theme. We call this inflation accelerating. So whether it's corn, cocoa, coffee, I mean, these things are up a lot absolute. But moreover, they're up a lot relative to what else you could have owned, which is going down, which of course includes the NASDAQ, the Dow Jones, anything in emerging markets, et cetera, et cetera. Now, what's the flow through on that? What happens when consumer prices go up? Your consumption goes down. Now again, if you only had $100, you can buy less with your $100. Now, the government doesn't teach it to you that way because they want to obfuscate this and talk about different things like inequality. But the reality is that this is what's happening. So look at consumer stocks for both the week and the year to date. Consumer discretionary stocks down 1.1% last week to 6% for the year to date. So awful. That's the worst sector in the S&P 500. And again, it makes sense. If inflation's accelerating, the consumer feels that in real time, and real consumption also starts to slow. So never mind the weather. The weather obviously is there, but also you're getting inflation accelerating into the base, which is new. This is not what we saw last year. Last year, what we liked about consumption accelerating was what? It was inflation falling. That's not happening. Basically, we're seeing the opposite of what just happened. Now, to finish, let's just hit on some Hedgeye playbook style factors. So again, style factors in your portfolio are basically styles that you can be long of or short of that can hurt you or help you. Now, the first thing that's really hurting, which is again, I'll point it out again and again and again and again, because GDP, 70% of US GDP is consumption. So if you're long consumer stocks, that's just not good. That's just not good. That's getting lit up. Second, high beta stocks. Now, high bases, and we rank these by quartile in the S&P 500, they're down 4.5% for the year to date. So again, underperforming the S&P 500 itself, which before this morning was down 3.6% for the year to date. And finally, from a style factor perspective, high short interest stocks. So again, we're trying to isolate style factors. Beta, high short interest, low short interest, growth stocks, low growth stocks. High short interest stocks, again, by quartile in the S&P, are underperforming the S&P 500. So again, a lot of high short interest stocks are growth stocks, and a lot of growth stocks are consumption stocks. So a lot of this shouldn't surprise you at all. And again, it shouldn't surprise you from a Hedgeye playbook perspective that our global macro themes of inflation accelerating and growth slowing is really leading you to the score that's on the tape for the year to date. If you have any questions about that, please ping me. @Keith McCullough is my Twitter handle.